Welcome to The Explainer. Today we're diving headfirst into a really fascinating, highly specific macroeconomic thesis laid out by market analyst Don Durrett. We are going to look closely at his projections for precious metals, the upcoming market seasonality, and a massive structural theory he calls the debt doom loop. Now, just to be crystal clear right out of the gate, we aren't taking any financial or political sides here today. Our only goal is to break down this complex analysis and really understand the data and the logic driving these huge forecasts. Okay, let's quickly map out our journey for today. We'll start by navigating the current correction, then look at the danger of seasonality, unpack the ultimate gold indicator, step inside the debt doom loop, and finally hit that November breakout target. All right, part one, navigating the current correction. Because to figure out where hard assets are going next, we've got to look at the recent and, pretty painful market realities our source outlines. So, we're starting off with a number that might make you gulp, 29%. Gold recently took a serious tumble from its massive peak of $5,600 all the way down to $3,959. Now, for a casual observer, a drop of almost 30%, that feels like a total crash. But the source actually identifies this as a perfectly normal, deeply necessary correction within a really healthy long-term bull market. Historically speaking, 25 to 30% corrections are totally standard in these precious metal cycles. And you know the old saying, right? When gold catches a cold, silver gets the flu. Well, we absolutely saw that ripple effect across the sector. Silver took a much harsher 54% nosedive, falling from a high of 121 down to 56. At the same time, mining equities felt the squeeze too, dropping about 37%. So it was sector-wide pain, but again, completely standard within the broader cycle according to this analysis. But here is the good news. Despite those staggering drops, the underlying structure hasn't broken down at all. The source points out that the foundational 200-week moving average remains totally untouched, way down there at $2,800. Since gold is nowhere near testing that floor, the current chart is viewed as unbelievably healthy. The smart money isn't looking at these cyclical pullbacks as structural failures. They're seeing them as prime accumulation phases. Moving right along to part two, the danger of seasonality. Because even with those healthy long-term charts, our source issues a very strong warning about the ticking clock of autumn. Let's look at the calendar, because this is where it gets real. While we might get a short-term summer relief rally, seasoned traders know there is a formidable seasonal headwind right around the corner. The explainer predicts a really dangerous window stretching from mid-August straight through October. During this time, traditional equities and hard assets alike face massive seasonal vulnerability, which frequently triggers secondary liquidations across the whole financial landscape. And their source doesn't sugarcoat this at all. The crucial point here is that during this upcoming autumn turbulence, he boldly predicts gold could slide right back below $4,000 again. If that happens, it's going to likely drag silver back down into the $54 or $55 range before winter even arrives. It's an ugly short-term picture, for sure, but it's an expected one. Okay, part three, the ultimate gold indicator. With that short-term volatility clearly mapped out, how are we supposed to actually track the long-term sustained breakout? According to the analysis, you can ignore a ton of market noise if you simply focus on the gold-to-S&P 500 ratio. This is the absolute linchpin. It's literally the single most important metric for understanding exactly when massive institutional money starts abandoning the stock market for the safety of hard assets. It essentially tracks market sentiment, telling you exactly when the big money is making its move. Think about the visual gap here. Right now, this ratio is sitting at a pretty sluggish 0.55, but the magic number, the breakout threshold, is 0.77. Crossing that 0.77 mark is the trigger. That's what signals a profound shift in global macroeconomic sentiment. Once that happens, the source firmly believes we are off to the races, trending toward a modern target ratio of 2.0. Which brings us to part four, inside the debt doom loop. To really grasp what's going to drive that massive capital rotation into gold, we have to look at this huge macroeconomic catalyst. Now, this is a heavy concept, but it is absolutely crucial to the whole thesis. The argument is that the United States is slowly but surely approaching a state of mathematical insolvency. Basically, the economy can't generate enough organic revenue to service its own debt anymore. This creates a doom warp. It requires central banks to perpetually monetize deficits by printing money, which inherently destroys the value of the underlying currency. To prove this is already in motion, the analysis points to a severe growing disconnect. Think about it. Average citizens on Main Street are drowning in surging costs for the basics. We're talking rent, car insurance, health insurance, simple repairs, while their incomes just aren't keeping up. Meanwhile, Wall Street seems entirely unconcerned, artificially insulated by a constant IV drip of monetary liquidity. Fear of a recession on Wall Street is practically non-existent, completely ignoring the underlying economic decay. Now, you might be thinking, wait, what about the current tech boom? Isn't AI going to save the economy? Well, the speaker takes a highly contrarian and genuinely fascinating view here. The analysis argues that AI infrastructure spending actually relies heavily on borrowing. In this view, it acts as a net economic drag by killing near-term white-collar jobs, sucking liquidity out of the system through massive debt, and failing to generate immediate, real-world ROI. It's viewed as a squandering of capital that actually accelerates the structural decay. Just look at the sheer math problem at the heart of this loop. It's pretty staggering. The government is running $2 trillion in annual deficits while paying out $1 trillion just in interest payments. The source predicts that when global creditors inevitably reject this devaluing debt load, the central bank will have to buy it all, triggering a massive, undeniable fear trade right into gold as global capital desperately seeks a safe haven. All right, our final stop, part 5, the November breakout target. So how does this massive macroeconomic theory and all these dangerous seasonal charts resolve into an actual unified market strategy? Let's look at the final roadmap. The source argues that precious metals investors essentially had to win 3 distinct battles. Battle 1 was gold breaking out, which happened slowly starting in 2020 and accelerating into 2024. Battle 2 was silver confirming that breakout, which it did when it shot to $120. So we've won the first 2. Now investors are simply accumulating shares, waiting to win the final war of sentiment, which happens when gold definitively starts outperforming the S&P 500. And the speaker throws out a really aggressive target here. The hope is that before the worst of the seasonal headwinds hit, gold pushes up past the $4,500 mark and breaks the $5,000 threshold, right as that dangerous autumn seasonality expires. Because once the calendar turns to November 1st, the whole game changes. The negative autumn headwinds completely vanish. According to the thesis, this sets the stage for a massive secondary leg upward across the entire precious metals board, running straight through the winter months of November, December, and January. Well, we've covered a ton of ground today, all the way from the technical floors of gold to the sweeping macroeconomic theory of the sovereign debt doom loop. The source's data points to a very specific, highly volatile timeline over the next few months, leading up to a potential paradigm shift in November. So I want to leave you with this question to chew on. If the doom loop actually accelerates and the AI illusions fades, is your portfolio truly prepared for this ultimate rotation? Thank you so much for joining me for this explainer. Keep a close eye on those charts and never stop learning.